Hi everyone, I'm Harish.
And I'm Taylor. Today, we're going to break down the different types of fees you may encounter when you start investing. What are they for? Why do they matter? We'll answer all of your burning questions.
As you've already learned, investing can be a great way to grow your money, but it's important to understand there are costs involved. Let's start by revisiting the idea of doing it yourself or DIY investing versus using a financial advisor.
When you invest on your own using DIY platforms, you typically pay several types of fees. Let's represent the money that you're investing with this coin. The first fee is a commission fee, which you pay every time you buy or sell a financial asset. Think of it as a toll fee, whenever you need to access your funds to make a transaction. This fee can be per trade or based on the value of the trade. These fees can add up, especially if you trade frequently. Some platforms offer a certain number of free trades per month, so it's worth comparing your options.
The second fee DIY investors face is a maintenance fee for holding your account, especially if your account balance falls below a certain amount. It's usually charged quarterly or annually. Think of this fee as a subscription to keep your account active and your money safe.
There are also other fees to be aware of with DIY investing platforms, such as withdrawal fees, when you withdraw money from your investment account, or inactivity fees, when you don't make trades or transactions within a certain period of time. It's essential to read the fine print so that you're aware of all the fees you may have to pay.
Now, let's talk about financial advisors. If you aren't ready to invest DIY style, investing with the help of a financial advisor is a great way to start. Some financial advisors charge additional sales commission when they make trades on your behalf. However, not all of them charge this. So you might be asking yourself, what exactly are these additional sales commission fees that a financial advisor may charge?
First, we have the front-end load, and the word front tells you a little bit about when this fee is charged. This is a sales commission charged when you purchase units of a fund. It's deducted from your initial investment, so you start with a little less money than you initially invested.
Next is the back-end load, and once again, the word back tells you when this fee is charged. This sales commission is charged when you sell units in a fund. This fee typically decreases over time in hopes of encouraging you to hold on to your investments longer. This can also be called a declining sales charge or a deferred sales charge.
The final fee is called the level load. Think of it as an annual subscription. This is an ongoing sales commission charged annually as a percentage of your assets. These are often combined with other fees like the MER charge.
What's important to highlight is that whether you invest on your own or through an advisor, in both cases you'll pay initial and ongoing fees on your investment. And in both cases, you'll also pay an MER. MERs are one of the main fees associated with investing in mutual funds and ETFs. It covers the cost of managing the fund, including administrative expenses, marketing, and other operating costs.
The MER is expressed as a percentage of the dollar amount of a fund's investment. MERs can vary widely among funds. For example, if the fund's MER is 2.5%, your investment of $10,000 incurs an annual fee of $250. This means your returns are reported after the MER is deducted.
That MER percentage is divided into three main components that make up the total fee. The first is the trailer fee. This is paid to your investment dealer to cover operations like research and regulatory compliance. It typically ranges from 0.25% to 1%. The next fee is taxes. Taxes like generalized sales tax and harmonized sales tax are included in mutual fund fees. The last fee is the portfolio management fee. This covers activities like investment research, securities trading, and risk management that are performed continually by those looking after the fund accounts.
It probably sounds like we've already touched on a lot of fees, but don't worry, just a few more to consider.
Brokers may often act as agents who organize and perform transactions in the stock market. Whether you're doing DIY investing or investing through an advisor, you are still using a broker in the background.
Brokerage fees can be based on a percentage of the transaction, a flat fee, or a hybrid of both. Some online platforms now offer commission-free trading for many stocks and ETFs, which can save you money.
It's essential to know that while commission-free platforms save on trading costs, they might charge other fees like account maintenance fees or fees for additional services. Always do your research so you aren't surprised by hidden fees.
Clearly, there are several fees to consider, but there are also some considerations you should make when analyzing costs associated with investing.
Definitely. There are several considerations, but three that are critical are: Number 1, knowing when to buy and hold. Number 2, tax implications. What taxes you may be subject to when you sell your investments. Number 3, investigating tax deferreds or tax exempt accounts. Knowing when to buy and hold is important because the more you move your money around, the more costs you incur.
Tax implications are another important consideration and often an ignored aspect of investing costs. For instance, when you sell your investments for a higher price than what you purchased them for, this profit from your sale is called a capital gain.
In Canada, 50% of the value of any capital gains are taxable, which means if you were to sell an investment for more than you paid, you'll need to add 50% of that gain to your income.
For example, if I bought a stock for $500 and later sold it for $800, that means I gained a $300 profit. When I do my taxes, I only have to add half of that gain to my income. So only $150 of my capital gain of $300 is taxed. This system encourages people to invest because it means you get to keep more of the money you make from your investments. Look at it like a little reward for taking the risk of investing in the first place.
So, don't forget on the potential tax implications. If you're unsure about the tax side of things, it's beneficial to consult a professional. They may know money-saving tips and tricks that many investors are unaware of.
Investing is a powerful tool for building wealth, but being aware of the associated fees and managing them effectively is key to maximizing your returns. These small annual fees can add up to large sums of money over years of continuously investing.
So, to wrap up, whether you're investing on your own or with the help of an advisor, understanding the various fees involved is essential. It helps you make informed decisions and keep more of your returns.
Thanks for joining us today. We hope that learning about fees associated with investing will help you better manage your investments and maximize your returns.
Be sure to stay tuned for our next Money Gains video. Have a great day.